Welcome to Forensic Accounting, Chapter 8, Register Disbursement Schemes. Much of what we're going to talk about in this chapter has already been covered in previous chapters, but we are focusing specifically on just the registered disbursement schemes within this chapter. So let me get started with minimizing this picture here and moving it off to the side. When we talk about registered disbursement schemes, we are talking about a sales register, and we'll see what these schemes are and how they are perpetrated. So there are two types of schemes over here. One is a false refund, and the second one is a false void. What's common in both of these? In both of these cases, what we're looking at is a sales transaction has already occurred. When you're looking at a sales transaction, the sales register, you're looking at cash receipts. We're not looking at cash disbursements, but that's exactly the schemes we're looking at in this chapter. So let's start with what a refund process actually looks like. In a refund, the customer returns the merchandise is placed back in the inventory, and then the purchase price or the invoice price, whatever we call it, is returned to the customer. So what are the journal entries that we have when there is a cash transaction or a credit transaction, and then the return? To start with, we have cash or accounts receivable debit, sales credit. In the perpetual inventory system, which is used by most firms these days, we have the cost of goods sold debit, inventory credit. When there is a sale that is made, we have the sales return and allowance debit and cash or accounts receivable credit. And as you know, the sales return and allowance account is a contra revenue account. What happens when the inventory is placed back in, when we bring the merchandise back into our inventory? The second journal entry that we had, which is a book entry, has to be reversed. Inventory debit, cost of goods sold credit. So what you would see over here is there's one part where we are looking at the physical cash register where the stealing is happening, the cheating is happening. And then there's what happens in the books. So there are two parts to this fraud that goes on. So there are three types of false refunds. The first one we're going to look at is a fictitious refund. And as the name suggests, it's fictitious, which means a refund never happened. The process did not happen, as in the customer coming and physically returning the goods. That never happened. So the fraudster takes the cash from the register in the amount of the false return. They're going to do the journal entry to debit the inventory system to show that the merchandise has been returned. So it's fairly straightforward with that. There is actually no physical inventory coming back. Now, if the inventory actually came back, which means a customer came and returned the goods to me, the employee could overstate the refund. That is the amount that is being returned to them. They could overstate that number. So what do? Let's say it's a $20 refund. They ring it up as a $25 refund. Give the $20 to the customer so that they don't become suspicious, but keep $5 for themselves. So they're doing the skimming. They're skimming the excess amount. The customers paid the exact amount, so they're not are not even alerted that anything is amiss over here. Now let's look at the third type of refund scheme, credit card refunds. So this is a situation where cash is not being refunded. We're not giving back cash in the process of the refund. Why would a fraudster want to put it back to a credit card instead of cash? For obvious reasons. They don't want to be physically caught stealing the money. They'd rather not that happen. Okay, so this is, they would probably, most likely, what they're going to do is they're going to put the refund back to their own card, and we'll see in the flow chart in a few minutes how that would be done. And how they can get away with it, obviously, is the bigger issue. So let's look at this. A customer, we're reviewing the false refunds. They actually return merchandise or they do not return merchandise. So let's start with they actually return merchandise. The refund could be a cash or a credit transaction. In the cash transaction, most common would be the employee who is doing the fraud would overstate the amount of the refund and pocket the extra money. If it's a credit card refund, how are they doing this? When a customer is actually returning goods, instead of swiping the customer's credit card, they swipe their own credit card. You give the receipt to the customer, and most of us, what we look to see is we see the amount has been refunded. We don't look to see whether it's our card number or not. So that's a mistake that many of us would make as customers, and you need to be alert about this because of this potential fraud. Let's look at what happens when there is no merchandise being returned, which means this is completely fictitious. It could be a cash refund, which means the employee is just stealing the cash, or it could be a credit card transaction. So in this case, since there is no customer involved at all over here, they're going to charge it back to their own account, or they could charge it to an accomplice. So which means there is someone else working there, and I charge it to their account. Now, obviously, in any of these frauds, a fraudster is concerned about being caught, so they're going to conceal. So what are they going to try and conceal away? How are they going to conceal their fraud? Well, the extreme case is you destroy all the detailed tapes. The second one is you conceal the shortage of inventory, so that when you're doing the inventory count, you fake the numbers so that it appears like you actually have the inventory. Another very, very common scheme is the refunds are below a review limit. Above a certain amount, you may need your supervisor to approve it. So as long as it's below that threshold, you don't worry about it. And then the other way in which they would do it is small amounts. You keep doing it small amounts every time, a few dollars here and there, not to raise suspicion. So the concealment of AR shortages, they could force inventory totals, which is what I mentioned a few minutes ago. They could write off assets as obsolete, therefore it's not over there. False credits to perpetual inventories, again, you're cooking the books over there. Pad the inventory. Again, these are, once I have the control over inventory and the return process, the fraud can be perpetrated in so many different ways. So once again, when we come to the part of trying to prevent these frauds, you're going to see the first item that's going to be listed is always going to be segregation of duties. That is, someone who's actually processing a return should not be allowed to have access to the books. Otherwise, there are going to be no checks and balances whatsoever. So once again, let's try and recap what happens over here. The customer brings the merchandise back. They have a valid receipt with them. The employee processes the return before issuing the refund, which means they take the merchandise back. You're supposed to also check the merchandise. And in a lot of cases, you need approval of supervisor. So if all of these processes are in place, what's going wrong over here? There may be no customer at all. There's no customer making a return, so that fictitious return we talked about. If the supervisor's signature is required, which means I do have a process, I do have the supervisor who has to give me the signature. The employee may forge the supervisor's signature. You could have a supervisor who is so overworked in a lot of cases, or the one who is really lazy, who is just going to rubber stamp everything. They're not going to really do anything in terms of checking the returns that are being made, as in not coming back to the cashier's desk and checking to see if an item is actually being returned. Is that the item that's on the receipt, and how the payment is being processed? The supervisor colludes with the employee. Well, that's even worse, which means it's an inside job. The supervisor and I am doing this together. And of course, the worst situation is if I am the supervisor. So I am the supervisor. I don't need anyone else's signature. It's my signature that processes the return. And the example that you see in the opening example in your textbook is exactly a situation along these lines, where someone had the supervisory authority to process returns, and they were the ones that were perpetuating, doing this fraud over and over again for quite an extended period of time. So with that, let's move on to the next one, which is very similar to the first type of fraud. We're now going to look at false voids. So they're very similar to scheme one, that is your false returns. So false voids is basically a sale transaction happens, and then for whatever reason, the customer says, I don't want it, or we made a mistake in the process of bringing up the return, and you void the return. Void means cancel it. So what do I need to cancel the return? I need the customer's receipt. Managers typically have to approve the void returns. Of course, if you have a rubber stamp supervisor, this process is going to become extremely easy. And if the management and employee conspire, they collude to perpetuate this fraud, again, it's going to be a really simple thing that can happen. Again, how would someone conceal this? Small disbursements, so you keep it below the review limit. Destroy records. You keep no record of what is happening. So in cases that have been brought to light, the employee typically what they do is they destroy records of what they have done, the voids, along with others. That way, to find out which one is genuine and which one is not is going to take a lot more time. And a lot of times management is just going to say, oh, well, just take it as this is the correct number. So clearly, management has a large role in letting these frauds happen. The goal is to prevent management from discovering who the thief is, which is why people would destroy the records. So let's quickly look at this flow chart. This is dealing with the voids. Does the company require a receipt? The answer should always be yes. Okay. After the customer has gone, does the employee void the sale of the receipt on the register? So what we're looking at over here is if a customer, we do issue receipts, but the customer does not ask for their receipt back, the employee now has a receipt in their hands and they can void the transaction. If they void the transaction, they can remove the cash from the register. The employee obtains approval for the transaction. Obviously, as we have mentioned, if the employee has the approval authority, they forge the signature, you have a rubber stamp supervisor, the supervisor is colluding with the fraudster. Now, once you have you bypass this level, again, we get to the concealment. And this is exactly the same as the previous case. Destroy the detailed tapes, conceal shortage of inventory, refund is below the amount. So the amount, when you do the voids, keep it below so that no one else will know what is going to happen. So these are constantly the challenges that a business is facing as far as in any retail industry that they face on a day-to-day basis. So is this topic important, or is this something that a management should be concerned about? If you're a retailer, the answer is absolutely yes. So you have various things to worry about. You have, which we'll get to in the next chapter, the non-cash assets, that is the inventory itself being stolen. Right now we are focusing on cash being stolen, the different ways in which it is done. So it could be done at the time of sale by way of skimming. It could be after the sale has happened by way of larceny. They just steal the cash. Or yet another way now we looked at is the canceling of a sales transaction by way of a refund or by way of a void, and getting voiding the transaction and getting the money that should probably have, if it was a correct transaction, gone to the customer, but the employee, the fraudster, is keeping it for themselves. So once again, like all the previous chapters we've talked about, how do you try and prevent any of these kind of fraudulent schemes from happening? Maintain appropriate separation of duties. Segregation of duties probably is the most important key to trying to keep a hold of this. Otherwise, you're going to be out of business before you even have started your business. So what are some of the things that we need to do? Management approval should be required for refunds and voided sales. So management approval, a supervisor has to approve those transactions. Closely guard access to control key or management code. So typically what you'd see at a lot of retail businesses, you have a manager or supervisor come in, they either scan their card or they type in a code. So they should be very careful not to share that information with anyone. Because if I know what the code is, I can just type in the code as if someone else has come and they have voided the transaction for me, given the approval. Never allow cashiers to reverse their own sales. So anytime a sale is made, if it has to be canceled for whatever reason, whatever amount, you need to have a supervisor involved. Require proper documentation. So what's a proper documentation? Both for voiding a transaction or for the refund, always the original sales receipt. Require cashiers to maintain distinct logins. And why would this be significant? This is significant because if I have to go and check who did this fraudulent transaction, I need to know who processed that transaction. So if every cashier has their own login, and for every time they have access to a register, if they log in, then I can find out who has actually done this. Periodically generate reports of all reversing transactions. This is a fairly standard audit procedure. Anytime you have returns happening, you want to check those returns, see who's doing the returns. Is there one person who's doing more of it? Is there a particular time of day in which it is being done? Again, an example given in your textbook. The person who is committing the fraud was colluding with other people in doing the fraud. That is, he had other people come in and do the fake returns, and he was sharing the money with them, the refunds at the fake returns, the false refunds. And most of those people would come in only when they needed cash, which was end of the pay cycle. When they were waiting for their next paycheck and they were short of cash, that's when they came in and all these things were happening. So there's typically a pattern that you could find out if there's such collusion especially taking place. Look for large number of transactions below the approval amount. So if constantly you see that there are, if $500 is your limit where you need the supervisor approval, anything above 500, if all your refunds are below 500, that's an immediate red flag. How is this magically happening? You need to look at that very carefully. Institute store policies encouraging customers to ask for and examine their receipts. A lot of businesses will tell customers that if we don't give you the receipt, then this sale is free or the next sale is free. They will entice the customers to take ownership in this process so that the customer makes sure that the employee is not going to steal from the business. So this is kind of a little trying to pass the buck on to the customer. However, you're also educating the customer and letting them know that if you want to make a refund in the future, we will want to see your receipt. So never walk away without your receipt. Randomly call customers who have returned merchandise or there's been a the sale has been voided. This again is something we've talked about in class, and a few of you have said that in your workplace, when you're asked to verify vendors, etc., you randomly call vendors. Here you randomly call a customer and find out if they've actually made a refund, a return, and they got a refund, and ask them to check their credit card. Was that amount actually credited to their account? Did they get the money back to their account? So it's not an unusual process for businesses to take to make sure that their employees are not doing something they shouldn't be doing. And lastly, and this is quite widespread now in terms of a preventive measure, businesses have security cameras. And these security cameras are there to help a business find out a variety of things. From a security measure, what you're looking at is someone stealing from me? Are they stealing my inventory? And now at the cashier's desk, I'm concerned about, is there anything happening at the cashier's register? So an example I can give you from someone I spoke with recently is, anytime they have refunds happening, they will check the register and see what time the refund happened. And then they go to the security camera and they go back and check at that particular time the refund that happened. So if it was supposed to be a cash refund and it shows up as a credit refund, they will verify with the camera and see what happened. And it's amazing how many people have been caught. Everyone knows there are cameras looking at us, but people still tend to get a little complacent and think they can get away with this. So as I mentioned earlier, this is an everyday problem for businesses, for retailers. It's probably not a significant problem in the service industry like a law firm or an accounting firm, but for retailers, this is an everyday problem. Anytime a customer has a right to make a return, the employee is there trying to make use of the opportunity if they intend to commit fraud. So these are things that businesses have to take care of constantly, because ultimately, if the business keeps bleeding cash in this way, they're not going to stay in business for too long. So these are not one-off examples that we're looking at. These are very common situations, which is why it is important to go over these scenarios. With this, we're concluding this chapter, and from next chapter onwards, we're going to start looking at non-cash theft. We'll look at inventories, other assets, and various other situations. So I shall see you in the next class, and I hope you have read through the chapter. If you haven't, please do, because you do have a quiz coming up in the next class.